Is Oracle stock a hidden bargain, or is it a dangerous bull trap? The charts are flashing clear sell signals, and the downward trend is hard to ignore. Yet some of the smartest contrarian investors are quietly calling it massively undervalued right now. Who is right, and where is the smart money actually moving? To understand what is happening, we have to look at what Oracle actually does. This is a massive global technology giant that serves as the absolute backbone of enterprise software, cloud infrastructure, and database management systems worldwide. They provide the critical cloud applications and infrastructure that power everything from massive corporate databases to the newest generative artificial intelligence training models. When enterprise cloud adoption and artificial intelligence infrastructure demand expand, Oracle booms. When corporate IT budgets contract or cloud migration projects slow down, it hits them first. Right now, this stock is heavily in focus because it serves as an ultimate health check for global business spending, cloud data center expansions, and major technology sector valuations. Before we dive into these critical chart levels, make sure to like this video, subscribe to the channel, and drop a comment below with your current strategy. Are you buying this dip, or are you sitting on your hands? Seriously, leave a comment right now. It helps the algorithm push this out to more traders. Let us pull up the charts and look at the raw technical analysis. The immediate trend direction is showing clear, consecutive lower highs and lower lows. We are seeing immediate short-term weakness as the price tests a major horizontal support level. If this current support zone breaks, the next major downside target opens up significantly lower, creating a vacuum that could accelerate selling pressure. On the flip side, momentum indicators like the relative strength index are hovering right on the edge of oversold territory. This tells us that while the sellers are firmly in control, the downward move is getting extended. Key resistance sits just above the recent breakdown point. Any relief rally is highly likely to face heavy selling pressure at that resistance line unless we see a massive spike in buying volume. When you look at Wall Street ratings and the broader institutional signals, the picture looks incredibly cautious. A significant number of consensus analysts have recently downgraded their outlook, shifting their ratings toward hold, sell, or even strong sell. The prevailing short-term outlook is dominated by negative signals, primarily driven by intense cloud competition, long deployment timelines for enterprise-scale data centers, and a general cooling off in short-term software capital spending. This institutional pessimism is putting a heavy cap on any short-term upside potential, leaving retail traders to fight against a massive wall of corporate sell orders. This brings us to the ultimate debate. Is Oracle genuinely undervalued, or is this a classic value trap? The fundamental bulls argue that the company's price-to-earnings ratio has dropped to historic lows compared to its long-term average, making it an absolute steal for a company with such a dominant and sticky enterprise client base. They see a massive margin of safety built on unavoidable long-term digital transformation and recurring subscription revenues. But the bear counter-argument is that traditional valuation metrics are completely deceptive at the top of an enterprise spending cycle. If earnings drop or growth targets compress because companies tighten their budgets, then a low price-to-earnings ratio today just means the stock is going to look much more expensive tomorrow. That is exactly how retail traders get trapped. They buy what looks cheap on paper, completely ignoring the macroeconomic shifts and structural headwinds. The downside risks here are very real, and the volatility is starting to expand. Oracle is heavily tied to the massive capital budgets of large enterprises, meaning its revenues are incredibly sensitive to corporate economic stress and cloud capacity pricing wars. If major corporate clients pause their digital migration strategies or shift toward legacy competitors, profit margins shrink rapidly. For retail traders, the risk is getting caught trying to catch a falling knife. Volatility shakes people out of their positions, forcing stop losses to trigger right before potential turning points. Let us map out the official bull versus bear case so you can see how this plays out. In the absolute best case bull scenario, we see a surprise stabilization in high growth equities and a massive new wave of cloud infrastructure partnerships, prompting a sharp short-term short squeeze. Buyers step in at current support, volume spikes, and the stock invalidates the sell signals by reclaiming its moving averages, opening the door for a steady recovery back toward previous highs. In the worst-case bear scenario, the current support level completely snaps on heavy volume. This triggers an automated wave of algorithmic selling, confirming a continuation lower and driving the price down to major multi-year psychological support floors before any real accumulation begins. Looking at the outlook, the short-term perspective remains incredibly cloudy and heavily skewed to the downside due to these persistent technical sell signals. However, the long-term perspective reminds us that database architecture, enterprise cloud networks, and essential corporate management applications never permanently disappear. Eventually, cycles turn and dominant market leaders recover. But that leaves us with the ultimate question for the days ahead. Are we watching the final capitulation before a massive historic rebound, or is this just the quiet beginning of a much deeper structural collapse?